and welcome to the first of our Isolas and COVID insolvency webinars. Um, I hope you're all well. I'm sorry we can't do these in our seminar room here at Isolas. The format's new for us. Um, the webinars are being used now more frequently. I, as a speaker, still find it a little bit difficult just speaking to a screen rather than an audience. But I hope that it'll be informative and interesting, or as interesting as we can make insolvency, really. To start off with, by way of a brief introduction, I'm James Montado. I'm a partner here at Isolas, and my colleague Samantha Grimes, employment partner here at Isolas, will both be presenting to you today on insolvency, what it means in COVID-19, the new COVID-19 rules relating to insolvency, and Sam will then be dealing with insolvency and employment, because inevitably it's going to be linked and inextricably linked. To start off with, I think it's useful just to have a recap on what insolvency is from a legal perspective. And I've just skipped an extra slide. There we go. There are two legal regimes for insolvency. There is presumed insolvency, and that is only a presumption, which means that you can prove otherwise, so it's rebuttable. And the test in that regard is that you fail to comply with a statutory demand that has not been set aside. And of course, with the new Insolvency Act, there was a regime for setting aside statutory demands if you feel that they've been issued incorrectly, where you dispute the debt. And as you may not know, or you may know, statutory demands are the principal tool which creditors typically use to rely on, so that you could then petition the court for a winding up, because of this presumption that if you cannot pay your statutory demand, you are deemed to be insolvent. The second of the presumptions is that you have a judgment or order against you, a monetary judgment, which you fail to wholly or partially satisfy. It's not to say that just because the presumption exists that you're automatically insolvent. You will have the opportunity at the hearing of the petition to go and say, well, look, it's just a small blip, or we are going through a process to try and set aside the judgment, or we do not feel that this is the correct process, or you can show, or at the time that the statutory demand was issued, you couldn't meet it, but that afterwards you are able to meet it. So those are presumed insolvency regimes. You can rebut them, so it's not terminal. But then you have the actual insolvency, and this is what we used to call the cash flow test and the balance sheet test. The first is if you are unable to pay your debts in full as and when they fall due. So if somebody, typically they'd be linked. If somebody issued you a statutory demand and you couldn't, then you were deemed to be insolvent because you cannot pay your debt as they fall due. But typically this means anything whereby you can't pay your employees in full, or you can't pay your water bill because of insufficient cash flow, then you're deemed to be, you are actually insolvent. And this used to be called the cash flow test. The other actual insolvency test is that the value of your liabilities exceed those of your assets. And that can happen for a number of reasons. It can mean that you've sold your, for example, in a COVID scenario, you continue to have employees because they can't be put on beat, they can't be furloughed. You still have to pay your rents, but all of a sudden, your stock, you've sold all the stock you have, but you cannot secure new stock, and then your balance sheet starts looking a bit skewed because you have a lot of liabilities there, but no assets in terms of stock or trade. So that's generally the insolvency regime. And also, by way of introduction, I think that what happens when you are in an insolvency, what a liquidator tends to look at and what directors are most concerned with are what's called avoidable transactions. And these can be found in section 249 to 252 of the Insolvency Act. And they are generally unfair preference, which is that you are putting a creditor in a better position than he would be if the company were just to go straight to liquidation. And for it to be an unfair preference, it must be what's defined as an insolvency transaction. And an insolvency transaction generally means one which you do when you are insolvent. And for this purpose, you can be either presumed insolvent or actual insolvent, or that the transaction itself caused you to be insolvent. So for example, by paying one creditor over another, you've literally wiped out your bank account, and now your liabilities well exceed any assets, or you have no cash flow. that transaction caused you to go into liquidation, that's an unfair preference and can be set aside. It's interesting that there is a link, of course, between the voidable transactions and the vulnerability period, because for all of the voidable transactions, they must be insolvency transactions, which I've just explained, but they must also be within the vulnerability period. And the vulnerability period, before I carry on with undervalue, floating, and extortionate credits, if it's a connected person, it's 2 years before one of three things: before the petition being filed for your winding up, if you're in administration and the administration then leads you on to a liquidation, it's the date at which the administration petition was filed, or if it's a member's insolvent liquidation, the date that the board resolution was passed. So from that date, you go back. If it's transactions related to a connected person, and a connected person is quite wide, meaning parent company, subsidiary company, directors, shareholders, or even family members of such directors and shareholders, then any transaction in the past 2 years fall within the vulnerability period. But for any other person not connected to the company, it's merely 6 months. The other voidable transactions are undervalued transactions. Those are gifts you've given, or something that the company has given away for no consideration, or alternatively, where you have given something away or traded something off at a significantly less monetary value than what it was worth. So your consideration fell significantly below the worth of it, unless you can say that it was in the interest of the company to do that. There was a real business need, or it was in the course of business. So there are a couple of exceptions with everything in the law, but generally undervalued transactions are quite rare. I think people have wisened up to this, and we will go on a little bit as to the reasoning why we have these liabilities and the ability to reverse things. Another voidable transaction is also the voidable floating charge, and this is any charge which has been created over the assets of the company within the vulnerability period. And there is, in fact, an interesting presumption there that if the floating charge is given in favor of a connected person, it is automatically presumed to be an insolvency transaction. So that's also something that's been changed, and we'll touch upon it slightly later on. And that's something that's been changed now with, that hasn't changed with the COVID rules, because it obviously protects companies from being pillaged by directors, shareholders, when there's an insolvency event. The final of the voidable transactions are extortionate credit transactions. And these are simply that you've entered into a credit agreement that requires you to pay an exorbitant amount by way of interest or by way of repayments, and one which really offends the ordinary principles of fair trading. They are quite rare, again, like voidable floating charges. The main ones that directors normally tend to be concerned with, and creditors, in fact, tend to be concerned with, are unfair preferences. So turning to the next slide, the consequences of insolvency means that voidable transactions entered into during a vulnerability may be set aside and reversed. Directors accrue duties to act in the best interest of creditors, and they can accrue potential personal liability. And the potential personal liability arises out of two things: fraudulent trading, which is very rare, and it's quite a hard one to prove, because you actually have to show an intention to defraud creditors and not simply to prefer one over the other, or that you are carrying on the business for a fraudulent purpose. So this is quite rare. I've not really come across it, maybe perhaps once in my career so far, and that was where there was a wider fraud being committed. But ordinarily, directors are more concerned with insolvent trading, and the definition for that, and of course there is exemptions and caveats as with everything in law, but the main test and what you have to be worried about is if at any time before the commencement of the liquidation, a director ought to have concluded that there was no reasonable prospect that the company would avoid going into insolvent liquidation and continued to trade, or failed to put the company into liquidation. And what that basically means is that you allowed a company to accrue debts which were not to the benefit of the creditors, and you allowed the company's situation to be worse. And what they're trying to do is to avoid that. They put in an insolvent trading provision, and one of the remedies you can have as against a director is that they need to cover and restitute the company for any losses that were obtained through that period. So obviously that causes a lot of concerns both for directors and for creditors. Just pausing there, I had a conversation recently, and somebody said, in respect of PAYE and personal liability there, which we'll cover, but they said that why should directors have any sort of personal liability if we sort of kept to the principle of corporate limited companies? And I think there's a balance really to be said. If we are given the legal benefit of having limited liability, so that a corporate entity is liable to the extent of its assets, and the individuals behind them aren't, that then could encourage people to take on unscrupulous business. And there was a time, of course, before these rules came in, these statutory rules came into place, where, you know, in the final death throes of a company, directors and shareholders would pay themselves extortionate bonuses, would sell the assets of the company to themselves for little to no consideration. And what it did was it in essence killed off any ability for creditors to recover anything. So I think it goes hand in hand. The fact that we have limited liability, which protects the owners of company and allows people to enter into free commerce, must be balanced and juxtaposed against the ability of those trading with the companies to ensure that, you know, the companies won't be phoenixed, that they'll have something to recover, and that the company itself is not run as a scam. So these rules, the liability, the reversible transactions, are aimed to ensure fairness to creditors and to make sure that the directors are accountable. And I genuinely think it's good and it's worked well, because as these rules have become more established, certainly there's been a greater awareness of directors' duties here, of the fact that directors accrue duties to creditors, no longer just the company or the shareholders. And because of that concern, it also may mean that some conservative directors, or directors who are really concerned about liability, perhaps enter into an insolvency process too early on, or they're too quick to push the button, especially under the old regime we had under the old Companies Act, where administration wasn't an option. The difference, of course, being administration is not a terminal insolvency process. A company can survive from administration and continue, whereas liquidation is an entirely terminal process. Once it is liquidated, that is it, it's gone. And these concerns about solvency and what directors should know and when their liability comes about has, of course, been exacerbated by events such as COVID-19, where businesses continue to suffer high staff costs if you can't furlough, expenses, rent, with the government rules not allowing them to trade. And that is clearly an issue for concern. It was raised with the government, and I, for one, welcome the fact that the government actually acted quickly in seeing this business need, because what happened, COVID has caused is a shutdown of the business, and it means that otherwise financially stable and healthy businesses ordinarily would have had to go into an insolvency process, simply because perhaps they don't meet the cash flow test, or perhaps rather rarely they wouldn't meet the balance sheet test. So the government introduced the new COVID measures in terms of insolvency, and generally how I've summarized them are in three parts: protection from creditors, protection for those investing or creditors who are paid by removing voidable transactions, some voidable transactions, and protecting directors from personal liability if they don't act. I would just say, sorry, I have forgotten to say this before, if you do have any questions, there's the chat feature. Please put your questions on the chat, and I'll do my best to either answer them as I go along or leave the questions to the end. Sorry, I should have stated that earlier. So on these COVID rules, we did publish an article a couple of weeks back. It's on our website that goes into these in a little bit more depth, explains the rationale behind them and its practical consequences. And if you're interested in this, I'd recommend that you read the article. But generally, I summarize it as this. The first of the measures are to protect companies from creditors. And these measures mean that creditors can no longer file statutory demands, and that is a significant one. As I said before, statutory demands are the main vehicles for which to prove that you can't pay your debts and therefore to petition the court for a liquidation or administration. It also prevents creditors from being able to place a company into administration or liquidation. Holders of security cannot enforce their rights without the consent of the company, and that also extends to repossession of commercial premises or repossession of properties under sort of hire purchase agreements. So if you had either a security, a mortgage, a charge, creditors will not be able to enforce that, for example, for non-payment. And in the case of charges, they won't be able to petition to place you into administration either, or to appoint an administrative receiver over those assets. And the final one, which I thought was quite an interesting one, of protection from creditors, because you can have one creditor who themselves are perhaps a bit concerned about their own solvency position and say, right, you know what, I need to collect from everybody, I don't care, I need to be seen to be doing everything, so I don't accrue any personal liability, and I'm going to go for my debtors. It prevents you doing that. It prevents otherwise healthy businesses going under because of one or two creditors, but also they have removed the ability of directors to petition in their capacity as directors, so directors qua directors, not directors acting as the company, from placing a company into liquidation. I think that's quite an interesting one, because you could see if you had a board situation and there were different appetites and different risk appetites to personal liability, or there wasn't even an agreement whether the company could trade out, you'd see a position here where one director may say, I don't want the liability, I'm going to petition the court for this company to be wound up. And that's now no longer the case. Those directors during this moratorium period, and I'll talk about the moratorium period a little bit later, have not got the right. Although it's important to say that others, such as the shareholders and the company itself, as well as regulators and administrators, if you're in administration, can still petition for the company to go into liquidation. So those are the first of the three limbs which I identified, which is protection from creditors. The next two are protection from avoidable transactions. And this is that it introduces, the new rules introduce a presumption that any bona fide commercial transaction, that's really emphasis, it has to be a genuine commercial transaction, entered into during the moratorium, is presumed to take place in the ordinary course of business. And the way that they've included and defined ordinary course of business includes COVID. So they've called it relevant circumstances. And relevant circumstances means anything arising from the COVID pandemic, anything in connection with the government rules on the COVID pandemic, the general marketplace as a result of the COVID pandemic, and a reduced demand for your goods or services as a result of the market conditions. So what they're really saying here is, we know that anything you do during COVID is exceptional, and anything you do to ensure that your business survives is going to be okay, because we're going to presume that it is in the ordinary course of business. And being in the ordinary course of business is, under law, a general defense to having an unfair preference being reversed or set aside. And really, we'll be touching on it a little bit later, but really what this does is allows companies really to pay some creditors above another. The other one, which they've introduced, is that the presumption that a floating charge in favor of a connected person being an insolvency transaction is disapplied. And I think this is really going towards a fundraising mechanism. If your company needs funds and you're going to a parent, a uncle, aunt, a parent is in parent company, or I suppose it could be your actual parent, if it's a family business, they may want some sort of security or some sort of charge over assets to help themselves and to secure the debt and to give them comfort. Ordinarily, if you entered into this, there was automatically a presumption that it would be an insolvency transaction and could be liable to be reversed. But what COVID rules does is disapplies that. So what they're saying here is, look, if you need to be creative and you need to get credit, or you need to, come up with deals or give things away or trade things off to fundraise to continue surviving during COVID and during these relevant circumstances, you can do that. And the people you're raising money from have the comfort of knowing that it is unlikely that this is going to be reversed. Because if you knew that what you were doing could be set aside, you might be less willing to give the money or to invest as much money. So that sort of covers the second limb, being protection against voidable transactions. And the last one, and probably most relevant for the audience today, is that the directors are given greater scope to try and trade out of solvency issues without being concerned about personal liability. What that does is, now they've eliminated liability in respect to fraudulent or insolvent trading, basically meaning even though the company continued to trade and entered into transaction where the directors knew or suspected it may be insolvent, insolvent being presumed or actual. And only does it, though, this is interesting, it only does it if the insolvency is by reason of COVID, and as I said before, the rules, market conditions, or reduced trade demand for services. So there is a link, it's a causal link. For you not to have liability, it must mean that your insolvency comes about as a result of COVID or the market conditions resulting from COVID. What this aims to do is to prevent a business that was otherwise failing before COVID trying to trade through, or a business that was doomed in any event trying to survive through COVID. It's literally just, and I think it's a very fine balance, but the way they've done it is if you can link it to COVID, you're fine. If not, you cannot abuse the system. And I think it's as good a balance as you're going to find, and as good a balance as you could probably draft in the time that we had to draft it. The other thing that they've done in respect of directors is that they've eliminated the summary remedies against delinquent directors for basically continuing to trade when you may have been insolvent. And that meant that instead of having to go through a full trial, there was a summary process whereby if you could prove that the company was insolvent and you could prove that they knew and that you didn't do anything about it, there was already that summary remedy against you. And they have eliminated that, but again, only linked to insolvency by reason of COVID, the market conditions, or reduced demand really because of COVID. So the effect of that is that directors now have more flexibility in determining whether or not to pay select creditors or whether to seek to raise funds from connected persons or others, because it now means that you can pay your electricity. If you're a restaurant and you're online on Hungry Monkey, Rock Hero, and you're not paid your Yumi bill because you're actually insolvent or presumed insolvent because you're having a tough time, but you haven't paid your Yumi bill, directors ought to know that by paying Yumi above everybody else, there could be an argument, I suspect, if it was terminally insolvent, there could be an argument that you shouldn't have paid it, although of course you could always rely on the fact that it's ordinary course of business. Or if you had a supplier that says, I'm not going to give you new stock until you pay me in full for what you already owe me, and you need that new stock to continue to trade, you would be able to do that. You'd be able to pay select creditors if they were threatening to cut you off of certain services, and you wouldn't have to worry about being or having created either an unfair preference or basically continue to trade once you were insolvent. Equally, you don't have to, creditors, those you fundraise from, don't have to worry that any security they take during this period could be set aside. And I should add now that all of these measures start off, and I think they may have commenced, I haven't seen the Gazette yet, but they may have, it was passed through Parliament, I believe, yesterday, but they haven't actually come into effect. So today you could not rely on this. So everybody today that has been trading, technically, potentially could be liable for insolvent trading, but I doubt that any liquidator would be looking at that. And I think there's great understanding amongst the insolvency practitioners and lawyers and creditors that these are uncertain times. But what the rules do is from its commencement, it creates a moratorium period similar to what happens in administration, where all of these rights and all of these measures come into place, and there is no end date. Because just because lockdown is being lifted, it may not necessarily mean that businesses can return to normality. So it's for an indefinite period until the government publishes a notice saying this is going to stop. So it could be 6 months, it could be 7 months, it could be a year, it could be more. So it takes us now to what directors should be doing practically. These measures, as I've touched upon, are not to help businesses which are already failing. They are to help businesses trade out of COVID conditions. They are to help businesses trade out of losses, out of insolvency positions, which have come about because of the government rules, because of restriction of freedom of movement, closing of establishments and shops. This is what it's aimed to do. Always, but more particularly now, directors need to be proactive if solvency issues arise. You need, if you're concerned about solvency, if you're concerned about the survivability of the business, you need to be keeping on top of it. My advice is, because all of the rules, everything you're trying to do is going to be so fact specific, that you need to probably have advice if it's getting really hairy. And a practical point here from experience, and Sam I think will confirm this when she does her bit, is don't leave it to the last minute to get advice, and don't leave it to the last minute to try and get an insolvency practitioner on board. Sometimes we have found in recent months actually, when dealing with gaming and other industry sectors. If you've left it too late, it means that options can come off the table. It means an administration may not be possible now, but a couple of weeks ago they may have been possible. So directors really do need to keep on top of solvency issues, probably meet more, and actually record decisions and make more notes, because various of these measures only create presumptions in favor of directors. Presumptions can be rebutted, so it's important that we make contemporaneous notes. Directors need to consider whether there is a solid business plan which allows the company to survive once normality happens, because if not, you're not going to be able to benefit. You have to link it to, we can trade out of this. We are doing this because we feel that we can pay everybody off, or everybody's going to be in a better position once we're able to trade, because we'll go back to the usual profit levels, we'll go back to the usual turnover of cash. And if you're going to pay selected creditors, whatever you do, my advice and my recommendation is that you record it in board minutes, if possible, explaining needs, why you need to make these transactions, which ordinarily you shouldn't be doing. Like it said on the slide, in order to maintain utilities, in order to pay creditors to continue to trade, to prevent people exercising rights you don't want them to exercise. And if you can, link them to COVID. It's really important to say, ordinarily this wouldn't happen. This is the situation we find ourselves in. We feel lockdown will be lifted and we'll go back to business in a couple of months. And in a few months, we ought to have, normal profit levels, and we'll be able to pay creditors off in 6 months. That won't be possible unless we do X, Y, and Z. So my advice is, and my view really on this is, that you need to be doing as much as possible, because if this all goes pear-shaped and anybody at the end of the day wants to try and reverse that, the best way to keep the presumption is to have contemporaneous records of the decisions and the reasons for those decisions. The one thing I think which is interesting is that these measures, if you are if a money lender, I suppose, or if you're in the business of venture capital, and you have a lot of money out with your debtors, and all of a sudden you cannot enforce them, and the payments stop coming in, that those types of entities themselves might have solvency issues, of course, and they then benefit. These, at least in Gibraltar, they then benefit from these measures. The issue I suppose you'd have is if you were, sort of a foreign company that was a parent or a debtor or a lender, and they couldn't benefit from this, and then they go into an insolvency process because they haven't got the same protections. But certainly Gibraltar companies, if you are owed money and you cannot take any steps to collect it, and that has caused you to be insolvent, you can also benefit, and the directors can also benefit from the same thing. It's crucial, though, that you keep a look at what your debtor book, if you are in this sort of business, you keep a look at what your debtor book is like. If you know that these debtors are going under, or they're really not likely to survive, you need to be realistic. The worst thing I think that anybody could do is to roll the dice, see, well, look, you know what, there might be a chance, there might not be, and then not enter into a solvency process. This really is, and I'll repeat this and I emphasize it, this really is only about ensuring survival of otherwise viable companies through COVID. And the important thing in all the rules is there must be that causal link between insolvency and COVID-19. Without that, it won't really work for you. So directors need to be more aware. You need to know, be realistic. If there are objections, if some directors don't agree with decisions being taken, put it down in the minutes of board minutes. Make your views known, record things, because this is uncharted territory. There is no case law on it, and ultimately we're all, hoping for the best but preparing for the worst. And directors can take some comfort, can be creative in how they try and navigate through COVID and do things which ordinarily you wouldn't be able to do. But you have to be careful on how you do it. And with that, I think that's all I have to say on that. I hope you've found it somewhat interesting. It is generally a bit of a dry topic. But as I said, if you're interested in this more, want to read a little bit more about the rationale and how things go, there is an article on our website that delves into this a little bit deeper. So that said, I'll pass you on to my colleague and partner, Samantha Grimes.
Thanks, James. Just a question. There is a question for you, James, from Chris Ann. I don't know whether you want to deal with that now before I move on.
Yes, I've seen that. It says due to being unable to file statutory files, will penalties be waived? If so, until when? I think this is I think you mean sort of statutory filings at Companies House. I think Companies House have published guidance on this. It did say that I believe the old guidance did say that nothing, that you could still do e-filing. So I'm not sure whether or not that answers your question. I think you'll be able to file things electronically. So therefore, I'm not sure that penalties would be waived. Certainly the court service have until recently, if you had fines and other penalties that needed to pay to court, that the enforcement of that was waived. But Chrysanne, if you want to email me and give me a little bit more detail, I'll be very happy to help you.
Okay, thank you. So morning everyone. I'm Sam, partner at Isolas, and a large part of my practice area is employment. So when James was putting this webinar together, he thought it would be a good idea to have a short segment on sort of employment aspects of insolvency. As you can imagine, it's probably quite a big area in itself and quite technical. So what you're going to get this morning really is a bit of a whistle-stop tour of issues I just want to flag up to you and considerations. So insolvency obviously causes significant concern, but I think it's fair to say, in particular for employees, they are normally sort of slap bang in the middle. They are fearful of losing their jobs, and often they're owed sums of money by the company, in particular wages, and they're wondering how they can recover those amounts. And we'll have a look at how they go about recovering certain amounts a little bit later on. But I thought what we'd have a quick look at is some practical employment considerations if you have a client who's thinking about purchasing an insolvent business. So you'll know that that insolvent business isn't in the best financial condition, and that's not going to improve. And of course, it may also have debts, including to its employees. Now, in a situation of administration of that company, so administration, and I'm sure James will correct me if I've gone wrong here, but as I understand, the administration process is all about selling the business as a going concern. It might be the entire business lock, stock and barrel is purchased, but alternatively, you might have a purchaser who comes in and who wants to carve out the best bits. And it might say, well, I want to buy your customer list, your IP and your equipment, but I don't want the nasty bits. I don't want these troublesome employees, for instance. I don't want their liability. So
for administration, Sam, the ultimate goal of, you're right, that's the practical element of it. That's how it happens in practice. The end game, you shouldn't place a company administration where the end result won't be better than if the company went into liquidation. So for example, if by placing it into administration, you are able to, as you've said, sell off the assets for a higher value because you haven't got the pressure of creditors putting you under in a fire sale, and that means that there will be more money left over as a result of the administration for creditors, then yes. Ultimately, the aim of administration is to be better for creditors than a liquidation. And that normally means selling things as a going concern because the value would be higher.
Thank you. That's very helpful. So from an employment perspective, what's the implication there if you do have a buyer who comes along and carves out what I'm calling the best bits of the company who is insolvent? Well, I think there the key consideration is 2P, and with any luck, a few of you on the line are nodding your heads now. 2P is effectively transfer of undertakings, and we have provisions in our Employment Act. And basically, what is a 2P transfer? Well, it's a transfer of a business or part of a business, which is in itself an economic entity, but it maintains its identity in the hands of the buyer. Now, I got some advice many years ago and that was in these sorts of scenarios where it's unclear whether something is or isn't a 2P, start from the point of view that it is 2P and work back from there. So I've always taken that advice with me. So I think if you have a client who is considering this sort of scenario and purchasing an insolvent business or part of it, then they should really be getting advice on 2P impact and risks surrounding that if they're not going to take on the employees. Now, something else I just wanted to flag up that's in our Employment Act is some flexibility it gives to a company that's purchasing an insolvent business. Now, say your client goes in and is purchasing the whole shebang, including the employees, but it gets there and it thinks, well, these employees are on really high salaries. How am I supposed to make a go of this? Now, our Employment Act allows all parties concerned to agree to make changes, including adverse changes to the contractual terms. So that's quite helpful and it gives a bit of flexibility. What you may not be aware of is that in an ordinary 2P situation, you're not allowed to agree adverse changes. Those adverse changes would be regarded as being void. So it does allow, as I said, a bit of flexibility in the case of in insolvent situations. Slide 2, please, my lovely assistant James. Thank you very much. No, you've gone a bit quick. There we are. So types of insolvency and their effect on contracts of employment. So we go in again to the administration scenario. So in this scenario, and again, James will correct me if I'm going wrong here, but the management of the company stays in place and the administrator is there as a guide and helping and taking them through the process in order to find a way through and perhaps realise the assets. So in this scenario, there's no immediate impact on contracts of employment. The employees continue and so do the contracts. However, what happens if that scenario then turns into a situation whereby the buyer says, I'm carving out the good bits, leaving behind the nasty, libelous employees, and then a decision has to be taken, well, are we liquidating that company? Do we have to shut it down? As James mentioned, the terminal situation. So we're shutting the company down. So what's the effect then? Well, if you look at the case law tells you that upon commencement of the liquidation process, that is tantamount to giving notice of termination of contracts to your employees. So there is a very big difference there between those two types of insolvency situation. Now we know in Gibraltar that the liquidator comes in and takes full control of the company upon commencement of the liquidation process. And the liquidator then will have to deal with certain paperwork elements in Gibraltar. So he or she will have to file the termination of employment forms, and likely the reasons stated on there will be redundancy on the grounds of the insolvency of the company or words to that effect. So what happens though if the liquidator needs a bit of help through his liquidation process? Well, in practice, what happens is he has to engage whichever employees he needs, likely obviously on a fixed term basis. So he might need somebody from IT, he might need someone from accounts, he might need someone who can do admin, things like that. So in practice, he'll need to file new terms of engagement to take those people on, and their costs will come from the cost of the liquidation. So going back to our scenario where the liquidator has gone into the company, he needs to close it down, and say he's got a gang there of 120 employees who are all very upset. They've received notice of termination. They know their jobs are lost. They're obviously going to be a bit upset because they may also be aware that under the Gibraltar Employment Act, if they're being made redundant, the liquidator needs to go through what's called a collective redundancy process. And one aspect of that is that there's a 60-day consultation period, so it's quite a long consultation period, and employees would expect to obviously be paid for that period. And I should just add in there that a collective redundancy process is applicable where you're terminating 5 or more employees during a period of 90 days. So where there is a liquidation of a company that's employing, you know, a fairly significant number of employees, these provisions will have application and will kick in. Now, is it a defence that the company is being liquidated? Well, there is a kind of defence in those collective redundancy provisions, and they say that if it's not reasonably practicable for the company to go through the process, that, you know, that's a potential mitigating factor there. So unfortunately, if you look at the case law, the fact that the company is insolvent and closing down will not be a defence to failing to follow the process, but it could be, as I hinted a few seconds ago, a mitigating factor. So the liquidator goes in, he's got his employees, he says to them, you're out the door, very sorry. There'll be a number of payments likely there that the employees are waiting for. So they'll want their notice monies, they'll want a redundancy payment, they'll want accrued outstanding holiday, and it may also be that they have an amount of wages outstanding. It could also be that there are employer pension contributions that they know have not been paid. Now, what they may or may not be aware of is the PAYE situation and also the stamp situation, so the social insurance. And I think James and I have had some experience where we've been advising companies, and sometimes they've had fairly significant bills owed to government in that regard. And James mentioned earlier on that directors can have some personal liability. So for those of you advising directors, you should also be aware there that directors have personal liability for PAYE. So it is a concern. So, you know, I would flag that up as a bit of a warning there, really. And in our experience, the government obviously can, but will go after these directors for that PAYE debt. Now, for what it's worth, my personal view there is that I think it helps if the directors have been engaging with government in advance, telling them what's happening, effectively keeping them on side and trying to agree the best way forward to handle the situation. We've seen government take a much heavier-handed approach for directors who just kind of wash their hands and want to try and walk away. So you're in your liquidation scenario and there are likely a number of creditors, and the employees also will sit there, of course, as creditors because they're owed all the amounts I mentioned to you a few moments ago, their notice, redundancy, unpaid wages, things like that. So say the liquidator comes in and he's able to scrape together some assets to sell, and he manages to get a bit of money in. So who does he pay? Are there any rules about who he needs to pay first? Well, as you would expect, yes, there are. And we look to the insolvency rules there, and that tells us who he needs to pay first. And effectively, he needs to pay his preferential creditors first. So who are the preferential creditors? Well, they do include employees for certain sums, such as unpaid wages. There are limits to that, though, I should add. And also pension contributions, again, limited. And the other, unsurprisingly, the other preferential creditor is government. So tax and stamp and things like that. Preferential creditors rank equally. So if the liquidator does manage to scrape together a bit of cash, he's going to divvy that up. Well, he's going to pay his own cost first, of course, and then he's going to divvy the rest, whatever there is, equally between his preferential creditors. So what effect is that for the employees? Well, if they're lucky, and I probably stress the word lucky, if they're lucky, they might get a little bit towards what's owed to them. And for anything else that's owed, they sit underneath the preferential creditors as an unsecured creditor, along with anyone else who's owed money. And it seems to me that, you know, you're bloody damn lucky if you get any money as an unsecured creditor. So what happens as an employee if you can't get the sums that are owed to you? Well, there is a government fund called the Insolvency Fund. It was created back in early 1990s. Where does it get its cash from? Well, all employing companies in Gibraltar actually contribute to the fund via their stamp contributions. And the fund does a very specific job. It's there really to pick up the tab if the insolvent company can't do so. So the fund, without going into all of the rules of the fund, it will pay certain amounts, and I should say to certain limits. So things like unpaid wages up to a certain limit and a maximum amount, accrued outstanding holiday pay, redundancy monies, notice in lieu, those sorts of things. And also, I shouldn't forget employer pension contributions as well. So the fund will make certain payments to employees, and you might say something is better than nothing, obviously. Now, just a quick note there on things like notice in lieu monies. Now, Gibraltar is quite a unique jurisdiction in that our law sets out what notice needs to be given by either side, by employer or employee. Now, often what we find is that contracts of employment have provisions for much longer periods of notice. So you might find anything between 3 and 6 months for more senior employees. So if that senior employee goes to the insolvency fund, what can they expect to receive? Well, they can only really expect to receive statutory notice. They're not going to get this 6-month notice period that might be set out in their contract. And the same thing can apply for redundancy. You know, there are odd companies in Gibraltar that operate contractual redundancy policies where they pay contractually over and above what the law says. And again, they're only going to get statutory redundancy monies. So just final slide there, please, James. So just to end, touching on COVID, really, you'll know as a result of the COVID regulations that were introduced that all terminations of employment need to be approved in advance by the Director of Employment. And, you know, that's, I think fair to say, caused a bit of chaos at the ETB, really, because there are still a lot of terminations that are being effected. So, and I should add that also applies not only to termination, but also to employees that are resigning of their own volition. And I suppose government thinks there it doesn't want companies putting employees under pressure to resign when it's linked to COVID and finding a loophole and a way around having to get consent. So in every conceivable scenario involving a termination of employment, you've got to go to the director and get consent. So you might be thinking, well, what happens then if you've got a company who is folding, it's in liquidation, so it wakes up Monday morning, it's payroll day, and, you know, the same week it's got a number of payments it has to make to, say, suppliers, to utility companies, to its landlord, anything like that. And it looks in the bank account, not got any money there, can't carry on, have to fold. So what happens there in light of this COVID requirement to seek consent for terminations? Well, you know, we're all sort of playing it by ear a little bit, aren't we, and feeling our way. But I can tell you in a recent situation that was pretty much exactly like that. We wrote to the director and simply had to say to her, very sorry, you know, we've not got time to allow you to consider this in great detail. You know, the company is going under, and it's going under today. And we do need to file those termination forms. The response that we received was, yes, some concern, obviously, but the director's sensible and she understands that this is a unique situation and the company can do little about that. So that concludes my whistle-stop tour of employment and insolvency. Thanks very much for listening.
Thank you, Sam. From us, just some, if I can change the slide, some final thoughts encompassing what Sam and I have said. I think it's what both of us are saying. It's important to really obtain the advice early on should doubts arise, because with everything in law, I'm sure many of you know, the devil's going to be in the detail, and application of the rules and everything will very much depend on the facts. Don't leave it to the last minute, because then some of the options may be off the table. And of course, be sure to record and justify your reasons for the decisions, especially where you later want to rely on the new provisions. And before I leave you, we've had a question in the chat, which I've managed to answer, but you wouldn't have seen the question, which is, do non-corporate landlords, i.e. individuals, have any rights to collect rents, especially if the rents in question provide the only income of the landlord? And this is in respect of commercial property. And unfortunately, you would rank, landlord would rank as a creditor, an ordinary creditor, unless you have some sort of security, but which you could take repossession. But these rules prevent you from taking enforcement action, in the sense of, yes, you can take them to court and you can obtain a money judgment, but if they don't pay the money judgment, you cannot petition for their winding up or administration. So you cannot really take it all the way. And the rules also do not allow the peaceful re-entry by way of repossession on commercial properties. So without the consent of the company, I'd say. So we've had a discussion there how it's not really great for those landlords who are individuals who rely on rental income for their only source of income, or the majority large part of their income, and they tend to be older people. Yes, I agree, it can be harsh on some. It's something which actually we discussed a little bit in the article which I mentioned earlier on our website, and it's about finding the balance. Of course, individuals also have some protection from bankruptcy under these rules, and that offers some sort of protection, but of course it doesn't replace you having, you know, your cash in hand. I suppose if you think about it long term, if you were able to enforce and kick the business out, would you really be able to get new tenants in? You know, would anybody be willing to take? Would you have to, you know, agree lower rents because of different market conditions if we come into a recession afterwards? Whereas perhaps holding out for a little bit may you know, mean that you get all of your money paid back, even if it's over a period of time. It is a balance. I think we recognize, and I've recognized in the article that I wrote, that it's going to be, it can't please everybody, but that it aims to balance short-term considerations against some sort of longer-term benefits for everybody, because it means that your tenants who would ordinarily have a thriving business, but for COVID, would be able to continue after COVID and continue to pay you and pay back everything you owe. So that said, if anybody else has any other questions, please feel free to get in contact with us. Thank you for attending it. I hope you found it useful, and you've just seen a little bit of a bio between of Sam and I, what we do and the things we've been involved in. So if we can be of help, we can be reached by internet, you know, phone, website, email, whatever. And yeah, that's it. If have anything, let us know. If not, we'll disconnect now. So thank you all for attending.